Jesus, Angie, get back to bed. It's about 3 a.m. where you are. Good morning, everybody. Welcome to the Morning Blast. It is September what day is it? 18th? Yes, I think it's the 18th. It's a Thursday. You join myself and Mr. Michael Brown, where we jumpstart your trading day with a look back over yesterday and a preview of today. But before we get underway, just a reminder that nothing discussed on this podcast is trading or investment advice or endorsements of this, that, or the other. That goes for me, myself, and Mr. Michael Brown. Speaking of the devil, how are you?
A very good morning to you, Ryan. Good morning, everyone. I'm not too bad actually. It was a very long and exhausting day yesterday, but productive. And of course, it's BoE day today to keep us all
Whoa, whoa,
on the
whoa,
edge of our
whoa.
seats.
Well, you were just hobnobbing it around some kind of conference yesterday. So probably on the $3 fizz and volivons, etc. So some
Well,
of us
do you
had to
know
actually
what?
some of
Do you
us
know
put a
what?
shift in.
Well, so did I. I left the office at 9 o'clock last night, but at this conference, I
Free
missed the
booze.
free. I missed the free booze. By the
No,
time
you
I'd
did not.
Well, by the time I finished moderating the panel I was
Oh,
moderating
oh,
and
humble brag, humble brag.
having a bit of a chat with the guys who I was doing that with, and talking to our good friend Michael Hewson, of course.
Good friend of mine.
By the time we walked out into the sort of atrium, the bloke was packing away all the glasses.
Oh, you've had a right shocker then.
I know. So yeah,
Well,
that
I'm not
rather
saying
put
it's the only
put a
reason you
downer on the
turn.
day.
I'm not saying it's the only reason you turn up to these things, but if anyone is
But
putting on an
it is.
event, they better have a free bar.
Yes, exactly that.
Um, Should we
Should we
crack
move
on?
on? I mean, we could talk about my professional activities, but we probably shouldn't. There's a small matter of an FOMC decision to wrap
Yes,
up from
yes.
yesterday, which I'll get onto momentarily. But what I will say firstly is that if you do open some charts this morning, then basically everything, whether it be equities, whether it be treasuries, whether it be the dollar, or maybe with the slight exception of gold, which does trade a touch softer, is basically where it was this time yesterday. We had a lot of what I would describe as whiplash over the FOMC decision itself yesterday. At one point, the Nasdaq and the S&P were down by about 1%. Then they rallied by about half of 1%. Half a percent, and then they closed basically flat. So the market a little bit indecisive and choppy around that Fed meeting and the announcement. And I think the reason for that is because what we got in terms of statement and the SEP was actually a little bit divergent from what we got from Chair Powell at the post-meeting press conference. So let's just break that down. Of course, the FOMC delivering a 25 basis point cut as expected, lowering the target range for the Fed funds rate to between 4 and 4.25%. Of course, that was an outcome that had been fully discounted by money markets in advance of the decision. Once again, though, it was not a unanimous decision. We had
It
11,
definitely wasn't.
we had 11 members voting for that 25 basis point cut, while new Governor Steve Moran, as expected, dissented for a 50 basis point cut. All of that then pretty much in line with expectations. The statement, though, was a little bit more cautious and dovish than we have heard of late. The Fed essentially marking to market their commentary around the US economy, and thank you to Henners at News Squawk for that description, which I've now
And as
shamelessly stolen. They noted that job gains have slowed, that the unemployment rate has edged up, and that inflation
oh,
remains somewhat elevated.
I
All
do
pretty
love a bit.
minor changes.
Do
Just
love a
don't
bit of
stop
edging.
talking. Stop talking.
We do love a bit of edging on this show.
Moving on. Very quickly, we all very minor changes, but in the central banking world, these are quite significant shifts. Which basically, the sort of translation is the Fed are more worried about the labour market than they
Yeah,
were
yeah. That is that.
in July. That's basically the takeaway.
Yeah.
The other important line that they changed in the statement was that they noted that there will be further adjustments to the Fed funds rate, not further reductions as we had expected, but they removed reference to the extent and timing of those further adjustments, which to me is basically the Fed saying, again, to sort of translate this into something resembling English, the Fed saying, we're more concerned about the labour market than we were when you last heard from us in July. We're also going to lower rates much quicker than we previously communicated in July, because they're basically saying we are going to cut rates, not we are going to debate the timing of whether or even if we cut rates. Into the summary of economic projections, the actual figures were little changed from what we saw in June. A marginally faster growth profile is expected over the entire forecast horizon. Unemployment is still seen at 4.5% this year, but now down at 4.4% next year, while both headline and core PCE prices are seen rising by 3 and 3.1% respectively this year, but returning towards the 2% target by the back end of the forecast horizon. Very good question, actually, at the presser. I think it was Mike McKee at Bloomberg said, for the last decade, you've said that you're going to hit 2% inflation in 2 years' time. You haven't actually done it. How can we believe you? And Powell floundered a little bit on that one. Just to stick up for Powell on that, the Bank of England have done exactly the same thing. Basically, if a central bank doesn't do it, they're shooting themselves in the foot and eroding their own credibility. They've almost got to say, we think this path is going to get us back to target and we're doing our job properly. But nonetheless, it does mean, as always, you need to take these projections with a bit of a pinch of salt. Meanwhile, the dot plot, of course, the expectations of individual policymakers as to the appropriate policy path, that pointed to a further 25 basis points of cuts being delivered this year, according to the median expectation, with another 25 basis point cut coming in 2026 and in 2027. The key thing, though, is when you look at those 2025 dots, there is a huge dispersion, basically a real range of views among committee members. There's no real consensus around what should be going on. You have 9 policymakers who put their dot in for 2 further rate cuts. You had 2 who put their dot in for just 1 further rate cut. 6 who put their dot in for no further rate cuts. And then you had one very lonely dovish dot that pencils in a whopping 125 basis points more cuts this year. Ryan, would you like to have a guess at who that might be?
Well, I won't have a bad thing saying against the guy because he's a follower of PIQ. So I take everything back. That the Big Bird meme that I made of him and stuff like that, which I obviously did before I realised he followed me. I take it all back if you're listening, Mr. Mirren. Yeah, all is forgiven. Yeah, I make you right, body. You do you.
You know what? It is Steve Moran with that dot. And Mr. Moran, if you are listening, toughen up. Because just because I slagged you off for being a puppet of Trump like you are, that doesn't mean you unfollow someone on Twitter. Stick up for yourself, man, if you hold your views with that much credibility. Anyway, rant over. The decision itself,
I'll
I would
have a
argue,
word.
is the decision itself, I would argue, is a lot more dovish than participants have been expecting, with those statement changes and with the dots moving to pencil in a total of 3 rate cuts this year, which is in line with what the swaps curve have been pricing, but certainly out of line with what the sell side have been saying. I think we'd all been expecting that the dots would remain unchanged. Things then got a bit weird, to be honest, at the post-meeting press conference. I've got to be completely frank, it was not Chair Powell's finest hour at this post-meeting press conference, although if Mr. Adam Linton at News Squawk is listening, no, Christine Lagarde would not have done a better job, as you suggested last night. The Q&A just got a bit strange, and it got strange when Powell started to try and frame the move today as, and I quote here, a risk management cut. Now, the dots and the statement don't suggest a risk management cut. They suggest that you are now resuming the journey back towards a more neutral setting of the Fed funds rate, and that a series of rate reductions are likely to take place over the coming months, which is my and pretty much everyone else's base case. When Powell stands up and says a risk management cut, it immediately makes everyone think, whoa, hang on a minute, is this one and done? You know, are you just taking this bit of insurance out at the September meeting and then you're not going to do anything else? It just puts a little bit of doubt in everyone's mind. And it was that line itself that saw the dollar start to rebound, and also treasuries start to pair some of the gains that they made initially as well. The rest of the presser was pretty much in keeping with what Powell's been saying recently, saying that the risks around the dual mandate are moving into, he called it equality, but basically to being more balanced. He was also saying that they should be moving in the direction of neutral, and again said that he had nothing new to share in terms of his future after May of 2026, and also wasn't drawn on any of the political nonsense that's going on with the Fed either. So I think
Nonsense.
I would not be at all surprised if we heard from Powell again in relatively short order. That will obviously depend on how the market trades over the next week or so as all of this is digested. But I do think it would be beneficial for Powell to, when the blackout period ends, of course, to just clear up some of those remarks around, what are the Fed actually thinking and we know what your reaction function is.
Yeah,
You quite clearly want to front load rate cuts. You quite clearly are concerned about the labour market. You quite clearly want to support jobs and employment and growth. I think Powell just needs to tidy up some of that clumsy language that was used at the press conference. But I think
yeah,
overall, despite what the market took as some hawkish remarks from the chair at the presser, the base case now has to be that the Fed are going to cut at each of the meetings that we've got left this year
yes.
in October and in December, probably by 25 basis points. God knows what Steve Moran will vote for. But there is obviously, I would say, the risks to that are skewed to the dovish side because the Fed are now placing developments in the labour market, particularly labour market weakness, above developments on the inflation side of their dual mandate. So I think a more dovish announcement that we expected, an announcement that in the longer run is bullish for equities, because you've got a Fed that is now, I framed it on a call to a client a moment ago, you've got a Fed that is now leaning in to support the market and to support the economy, as opposed to being restrictive and essentially being a bit of a hindrance to things. So although stocks had a bit of a wobble yesterday, I think the path of least resistance still leads
You
higher in
took
my
the words
mind.
out of my mouth. I was about to say our favourite phrase on this, path of least resistance is higher. And what resistance there was has just been greased up. And,
Oh,
get the lube out. We're going up.
oh God.
Sorry. Are you done?
Well, no, I'm not. I've actually got
Go on.
quite a lot else to mention, but
Go on.
I
Go,
might
go
be
for it.
done
Go
after
for it.
that
I'll
remark.
get comfy.
Oh God.
Oh, God.
We also had a policy decision out of Canada yesterday. The Bank of Canada delivering a 25 basis point cut to their own lowering rates to 2.5% as expected. They noted that they will, quote, proceed carefully with further rate moves with a focus on risks and uncertainties to the outlook. A little bit more caveated, actually, than their previous guidance. So somewhat pouring a little bit of cold water on the potential for further easing north of the border. Elsewhere, just a few other bits and bobs to mention. A couple of headlines out of China overnight. Well, actually, one of these came yesterday. China reportedly have told their tech companies to stop buying all NVIDIA AI chips. This applies to any fresh orders, but the government also wanting existing orders to be cancelled. Of course, this comes in the aftermath of the anti-monopoly charges and investigation that we were covering on the show yesterday. Again, not entirely sure it impacts NVIDIA, especially because, unless people are getting them in through the back door via Singapore, which they might continue with anyway, NVIDIA have assumed zero Chinese sales in their guidance. Sticking with China and tech, they have decided to drop their antitrust probe into Google or Alphabet.
Yes.
Apparently this came out of the US trade talks in Madrid earlier in the week. That is also according to the FT. And again, according to the FT, I mean, have the FT become a serious newspaper again? They seem to have done a
Whoa,
lot of
whoa,
news
whoa, whoa.
gathering here.
Let's not get carried away, but there have been, to be honest, this is a very valid point because even the editorial content seems to be much more unbiased towards anti-UK, pro-EU on that front, which obviously was a very, massive red flag for a long time. But yeah, this whisper it, but potentially they're getting their act together.
Well, if they are, I mean, that's very good to see. That's very good indeed. The other story I was going to say from the FT, of course, is that the Trump administration reportedly looking at plans to use tariff revenue in an effort to support US farmers with various grants. I'm
Indeed.
sure I see Angie Setzer was on the call. I don't know whether she's still
She
here.
is.
Yes, she
She
is.
is.
Good
Of
morning.
course she is.
You've got about 5 hours to work out what that means and cover it on the grain blast later on. Moving on, just a couple of other stories from me this morning. The first, quite an amusing one. Those in glass houses shouldn't throw stones, as they say. I'm going to read this verbatim from Bloomberg, and people can make up their own minds. This is according to Bloomberg, citing their own sources. And I quote, US Treasury Secretary Scott Bessent once agreed to occupy two different houses as his principal residence at the same time, mortgage documents show. The same kind of contradictory pledges that President Donald Trump has been using to try to oust Federal Reserve Governor Lisa Cook. I would not put any money whatsoever on Bessent being investigated for this because, of course,
No.
he is an ally of the Trump administration as opposed to someone they view as opposition. But I do wonder whether this is why he was trying to square up to Bill Pulte the other day. Basically, shut the fuck up because
Yes.
I've done the
Yeah.
same thing.
Yeah, right.
Um,
Keep your fucking mouth shut.
Last, but by no means least, just one headline in the AI space this morning for Tom Talks Cars. Very good morning to you. Huawei, they have unveiled a new AI chip tech to rival
Great.
NVIDIA. The company is going to launch its Ascend 950PR chips during the first quarter of next year and plans a series of launches through 2028, including the Taishan 950 Super Pod,
Love that one.
which will be
Love that
used
one.
for, well, hang on, I haven't finished yet. And that will be
Okay.
used for general purpose computing in the second quarter of 2026.
Love it.
The thing that story doesn't say is that all of them, no matter how fancy their name, will be used to spy on you and send your data back to the Chinese.
Indeed. Right. Are you done?
I am now, yeah.
Right. Awesome. Thank you for that. So as usual, I will read out a summary of the overnight news headlines. Just a heads up on this. We, again, do subscribe to the Substack, etc. I'm trying a slightly new format this time. I'm actually kind of condensing the raw headlines that Zach puts out, and putting them in a more of a summary kind of way based on the topics, etc. So do let me know what you think on that. Obviously, we do link up Zach's raw headlines as well. But anyway, let me know. Macro news: Japan's political transition and BoJ policy to start off with. One of the ex-BoJ guys, a veteran fiscal dove, I'm not going to pronounce his name, announced her candidacy for Japan's ruling party leadership race on October 4th to replace PM Ashiba. However, sources suggest the Bank of Japan will likely maintain its rate hike stance regardless of who becomes the premier. This is as inflation remains sticky. Former BoJ executive Shimoda said the central bank could raise rates in October even if Takashi wins. Japan's core machinery orders fell
Did you say
4.6.
Takashi? Didn't he have a castle on one of those weird Japanese game
Takeshi's
shows years
Castle.
ago? Yeah.
Takeshi's Castle. I still watch that on Challenge TV if I can't sleep. Well, we'll say it's because I can't sleep. But yeah, there we go. Great show. Japan's core machinery orders. They've dive bombed really. Careful.
Oh no.
Bad turn of
Oh
phrase,
Ryan.
Ryan. Bad turn of phrase.
Oh
Oh
God.
God, Ryan. Right. Anyway, they fell 4.6% month over month in July, worse than the expected 1.7% drop. So keep an eye on there. Moving over to China, China's market dynamics shifts. Chinese stocks extended gains to touch another 10-year high on Thursday morning, driven by AI chip developments and reports that local tech giants were banned from buying Nvidia chips, as Michael was talking about just now. However, prices did reverse lower in the close amid profit taking, that classic phrase that everyone likes to use when they can't understand what's been going on and why the market sold off from a bid. China has suspended unofficial subsidies for copper and nickel imports from Russia. These were made before Putin's September visit. And Chinese banks have loaded up on government debt at the fastest pace since 2019, with holdings up 20% year over year. Moving over to US policy and trade moves, the Republican-controlled House cleared the way for a vote on the stopgap funding to avert government shutdown. So, yeah, it's that time of year again. We're about to get a load more of these headlines and
Wonderful.
the usual clowns saying that they know for a fact the government's going to shut down. We'll wait and see. Nomura, they now expect the Fed to deliver 25 basic points cuts at both remaining meetings this year. US retailers, they've wrapped up holiday goods imports a month early to limit tariff-related costs. See what I did there? Wrapped up holiday-related goods. The Trump administration is planning to use tariff revenue to fund US farmers, as Michael said just now. Again, all eyes on Angie. No pressure to tell us what this actually means. 2:45 London time. Moving over to just general central bank actions. Hong Kong, obviously, we know what the Fed's done. Hong Kong cut its base rate by 25 basis points to 4.5%, as usual, following the Fed. The Bank of England is expected to slow its bond reduction program to £70 billion annually from £100 billion, but more from Michael on that soon. Australia's unemployment, that unexpectedly fell in August while jobless rate held steady. Sticking with the antipodes, New Zealand's economy shrank more than expected in Q2, increasing expectations for steeper October rate cuts. European challenges mount. Switzerland's exports to the US plunged 22% in August following a 39% tariff implementation. Moving over to the UK Chancellor Reeves It's considering staggered stamp duty payments to support housing. French workers, good on the French. Guess what's coming next?
Are
Yes,
they on
you've got it.
strike?
They are going on strike, including
Wonderful.
teachers, train drivers, etc., etc. They're striking today with budget cuts that are needed, or else the French are going to go bankrupt. But who cares?
Sorry, just
Uh,
on this,
yes.
if anyone from the RMT is listening, I will pay for your Eurostar ticket to go over there and see how to strike properly, not you layabouts lying around with a thermos outside London Bridge with one
Well,
of your mates.
yeah, I was going to say they're not even doing that for half the time. But yeah,
Well, yeah,
exactly.
quite.
A majority of Britons expect the economy to worsen amid inflation concerns. I would say, pretty much anyone with any with an IQ above that of a slug would expect the economy to worsen, to be honest, but there we go. Geopolitical news, US Middle East tensions. Trump is privately frustrated with Netanyahu's hardline Hamas approach, but continues public support without applying pressure. Military lawyers are raising concerns about legal implications of Trump's expanding campaign against Latin American drug cartels. And senior US diplomats focused on Syria have been abruptly removed as Washington seeks to integrate Syrian Kurdish allies with Damascus. Moving over to Asian Pacific security, Chinese Defense Minister Dong Yan warned against external interference over Taiwan as Beijing's Security Forum went on, delivering sharp criticism of, quote, bullying in a veiled swipe at Washington. Taiwan's National Institute, the Huangshan, again, apologies if I'm butchering this, they signed a procurement contracts with 6 US and Canadian firms. China and South Korea's top diplomats pledged to deepen strategic partnerships in the first meeting since Seoul's leadership change. Equities, before I hand back to you, obviously we've heard about Huawei and the chips, etc. Research group Semi-Analysis says that Huawei's products outperforms Nvidia's on some metrics, and China decided to end its antitrust investigation into Google, as Michael said just now. So moving on from that, tech infrastructure expansion. Apple held supply discussions for the foldable iPhone test production in Taiwan. This is targeting a 2026 mass production in India with 95 million units planned. That's over a 10% increase from this year. Palantir, so no one knows what they do, pledged 1.5 billion in UK investment while winning a Ministry of Defence AI software deal. Google, they're planning 4 new African infrastructure hubs to connect underwater fibre optic cables. Meta, they've announced a new $799 smart glasses with built-in display available from September 30th. I'm hearing some people on Twitter today saying about the demo that Zuckerberg did for these was a bit of a disaster, but I have no idea if that's legit or not. Sorry, I've been a bit busy this morning. Corporate moves and challenges. Several XAI executives left after clashing with Musk's advisors over management and financial health concerns. Moving over to Roche, they will acquire 89bio for up to $3.5 billion to enter the obesity treatment market. Fatties rejoice. ExxonMobil, they're halting over 100 million in European chemical recycling investments due to new regulatory concerns. Shein, they are offering other fashion brands access to its Chinese manufacturing network as a service amid US tariff pressures. And finally, for me, before I hand back to the big man, earnings and guidance updates. Bullish crypto exchange swung to profit in its first public quarterly report, with shares at 4.5% after hours. Nucor cut current quarter guidance, expecting sequential profit declines across all 3 segments, sending shares down 3% after hours. UK retailer Next PLC warned of sales slowdown in H2, forecasting anemic UK growth from increased regulation and higher taxes. And that's it from me. Back to you in the studio.
Very good. Thank you, Ryan. In
You're
terms of
welcome, mate. You're welcome.
Good. In terms of today, then, in 5 minutes' time, at the top of the hour, we've got a policy decision due from Norway. The Norges Bank expected to deliver a 25 basis point rate cut, lowering the benchmark rate to 4%, and will probably signal further cuts on the horizon. The main event of the day, though, comes just down the road on Threadneedle Street at midday London time, with the latest Bank of England policy decision. The BoE expected to hold bank rates steady at 4%, having delivered the 5th cut of the cycle last time out in August. Although once again, that decision to hold rates steady is unlikely to be a unanimous one. Instead, consensus favours a 7-2 vote split, with external members Dingra and Taylor likely to dissent in favour of a 25 basis point cut. Meanwhile, the policy statement should reiterate that the bank are going to take a, quote, gradual and careful approach to future policy easing. It is, though, the balance sheet that is likely to be in focus from the BoE today. Of course, the September meeting, as usual, is when the bank conduct their annual review into the asset purchase facility. For the last 3 years in a row, the BoE have been letting £100 billion worth of their bond holdings run off that balance sheet on an annual basis. That envelope, though, is likely to be trimmed quite significantly at today's meeting. One of the reasons for that is that when you look at the breakdown of the bank's gilt holdings, you've got just £50 billion worth that are set to mature. So if you want to run down the balance sheet by an amount greater than that, you need to conduct active gilt sales, which the BoE have been doing in previous years, and in fact since they started this process of balance sheet runoff. But of course, those active sales not only result in the bank crystallising a loss on their holdings, but they're also adding a premium onto UK gilt yields. And according to the bank's own research, that premium could be as much as 25 basis points on the 10-year gilt, which is to say we couldn't be doing with that at the moment, when it's the last thing the economy needs, is probably an understatement. Last year, if we do a bit of maths, the bank conducted a total of £13 billion worth of active sales. It seems very unlikely, to be honest, in the current environment that they would want to increase the amount of active gilt sales that they conduct, given the fragility that we've seen at the long end of the curve. So what that means is you end up with an envelope of basically 50 plus 15, which takes you to 65 billion, which is probably where the bank will end up in terms of the amount of bonds they will let come off their balance sheet over the next 12 months. Of course, the market going to be very, very sensitive to this for a number of reasons. Firstly, from a pure supply perspective and the impact that has at the long end of the curve, but also from a fiscal perspective, because of course any losses the bank are making have to be indemnified by the Treasury. And if the Treasury is spending money, that is eroding Rachel Reeves' fiscal headroom. So this does have...
Can we, we need to draw a line under this. Let's be
Well, it
clear,
doesn't exist, does it? But
yeah, there is no headroom anymore.
well, let's just call it room.
Yeah. Okay.
But yeah, so it does have potential budgetary implications as well. So I think this is going to be in sharp focus a little bit later on today. Besides that, there is no post-meeting press conference or fresh economic forecast due, but the governor has done sort of media rounds on decision day for the last year or so. So do expect some comments from Bailey at some point during the day. In terms of market expectations, the market pricing absolutely nothing for today. And in fact, not fully discounting another 25 basis point cut until next April, which is, quite a long time away and seems far too hawkish in my mind. Elsewhere, just very quickly, we also have the latest US jobless claims stats out today. Initial claims seen falling to 240,000, down for a prior 263. That does coincide with the September non-farm payroll survey week. And of course, remember that the prior figure was skewed higher by fraud in Texas. So that's likely to come out of the data this week. We also get the latest manufacturing data from the Philadelphia Fed at 1:30 this afternoon. And in terms of other bits and bobs to keep an eye on, we do get earnings after the close from FedEx. They are a useful bellwether stock, and we'll see whether they can deliver. And then, of course, overnight, as Ryan, you alluded to, we've got a policy decision due from the Bank of Japan, where we're expecting rates to remain steady at 0.5%, but obviously be on alert for any guidance tweaks given the political uncertainty. And that is all from me for the time being.
Wonderful. How we've crammed that in to 30 minutes, I have no idea. But
I think we're pat on the back to each other there.
I think it just, it belies how professional we are in this game, and
steady on.
Well, yeah, right. Well, anyway.